What is going on, everybody? Happy Monday. Welcome back to the Tradier Hub for episode 173 of Man and Machine, here with the PeakBot team and special guest, Matt Cashman from the OCC. How are you, Matt?
Oh, I'm great. How are you guys doing?
We are doing well, Ben.
We're doing all right. Hey, Matt, I know you've been on this show before, but I just want to make sure for anybody new tuning in, can you just give a little background on yourself?
Yeah, absolutely. I have been an options trader for almost 25 years. For the first 20 of those years, I was a market maker on the CBOE and other places. I started on the CBOE, and then I moved to London and traded for DRW there and ran an interest rate desk there. And then came back to the United States and started an index market making business on the floor of the CBOE. They like to be called the CBOE now. And ran that for about 10 years, wound that down before COVID. And then now my current iteration is that I work at OIC and OCC, where I am the principal of investor education, where I teach people how options work. So that's the full arc in 42 seconds.
Love that. Now I am curious because your role is mainly in education right now, right? And
Yep.
You're talking to, I'm going to say, thousands of people every single week.
Oh yeah.
How well do you think the progression of knowledge of options trading is progressing in this industry? And we're always curious to know, like, hey, how many more people are getting in here? Because we're obviously automating options, so we want to know what that market is feeling like.
I think the kind of the uptake of the information is still like hockey sticking, because of just the availability of data that exists that people have access to for free, essentially, that they didn't used to have access to. I think that's a giant democratizing force across the entire industry. And I think it continues to drive, particularly like retail and pro-tail, that side of the business is continuing just to, it's growing at an incredible rate. And the education, the challenge for me and for the team at OIC and for OCC is to try to make sure that we do everything we can to keep up with the demand that exists there for the education. Because as you can imagine, people who have access to all of this data all of a sudden, and access to a zero cost brokerage, essentially a frictionless way to interface with the market that didn't used to exist 10 years ago.
Yeah.
And the access to trading leverage contracts need the ability to educate themselves as to what they are, and what they can and can't do. And so that's really the challenge that I have and that our team has, is that we have to constantly try to meet people where they are and make sure that they understand how the leverage contracts work, because there's a lot of people involved in this market that weren't involved in it 10 years ago. So
right.
Yeah.
So it's crazy to look at the progression over the last 10 years and makes you wonder what the next 10 years is going to look like. That's going to
I agree.
I
know what it's going to look like. A lot of automation.
A lot of automation, baby.
Yep. A lot of AI, a lot of automation, and we won't talk about it on this show. Maybe we'll talk about it Friday, but potentially dropping the PDT requirement in your account from 25K to 2K. There's going to be a lot of day trading. That's going to spark some bot usage.
I was going to say algo trading gets a lot busier and a lot more chaotic at that time. And it becomes, truthfully, it's a good thing and a bad thing, because I think the amount of resources and tools that are going to be available is going to be an incredible, nauseating amount. And most of them are going to probably be terrible. That's the
nauseating amount. I love that.
Yeah. But yeah, bot versus bot. Doug, what's going on? Good to see you. Thank you for joining. And yes, absolutely. So, all right, guys. Well, on today's show, we got a lot to cover, both macro and micro, and we like to start the show with having a little bit of fun. We're going to start with a segment we call Stocks in Real Life, where we pick a stock. We talk about our experiences with this stock in real life, whether they're good, bad, ugly, or anything in between. And then we take a look at the chart and talk about any experience we've had with the stock, we traded it. And Ben and I were talking backstage about a potential trade idea, not financial advice, but just we're looking at the chart here and we might have something to share. So Ben, why don't I hand it over to you and then we get into it.
Yeah, I mean, so today's stock in real life is going to be ticker DIS, the Walt Disney Company. And for any hardcore PeakBot automators, if you're on Terry's Tips automates Disney.
Yeah.
And there are hundreds of contracts flying around every single week on Terry's Tips. So shout out to our partner, Terry's Tips. You can automate with him at terrystips.peakbot.com. Why don't you go ahead and check that out? But Walt Disney, the Walt Disney Company, I don't know if this is their slogan. And every week we talk about this stock. The individual that goes out and finds the slogans for these companies, I know they're just Googling what is this company's slogan. Yeah. But I don't think this is Disney. I think they'd be a little bit more creative than that.
Sometimes I think that's creativity. Everything's been said and everything's been done to where, and if you want to be unique anymore, you have to just be so on the nail about it.
Open now.
Yeah, this is Disney. This is us. This is it. No, you're right. That's probably not it, but I'm sure it's in their press somewhere. Let's talk about the experience. Any Disney adults on the call? I'm not trying to expose anybody. I'm not saying it's a bad thing. Are any of us? I am not a Disney adult. I love Disney, but I'm not a Disney adult. If we're aware of this phenomenon,
I think the way you phrase that makes it sound like there's a negative connotation.
No. I think you saying that right. That's the problem. You are the problem. Not me.
Is the Disney adult the adult who wears the ears at the theme park?
I would say that qualifies it. Yeah, because look, I'm an adult who gets excited about Disney when I'm at Disney. Okay. But I'm not putting my whole life around it. That there's a very big difference. Hey, Ben, I know a few of them. I know Ben knows a few Disney adults. We've got a couple in our friend circle. They're good people. These are normal people until you talk about Disney. So look, I love the parks. I love going to the parks for the food and drink and the occasional roller coaster. That's my thing. Okay. What about you guys? When was the last time we were at a Disney park? Matt, what about you?
Ooh, probably 10 years ago. I have a 15-year-old daughter, and so I'm sure we took her for her like 5th, 6th, or 7th, or all 3 of those birthdays or something.
Nice.
Which is entirely plausible. My feeling about Disney is always I left feeling happy for the experience and slightly overcharged for what I got, and always feeling like I could have spent the X thousands of dollars that I did spend taking my 5-year-old to like France, but Disney is where it's at when you're 5, and that's.
But cool. there is a Paris section in Epcot.
Yes, there is. You're right about that.
And there's one in Paris, isn't there? Disneyland in Paris, isn't there? France, right?
It was called Euro Disney.
Yeah,
I don't know if it's still there or not. Yeah.
No idea.
They closed it for a while because the Europeans were kind of like, I don't know how great this is.
What an American thing this is.
Yeah, they were like, you want us to sell a whole turkey leg?
Yeah, people are gonna eat it. Believe me.
For 23 euros? That seems like a lot.
Ben, what about you, man? What about you? When was the last time you were at a Disney park?
So a couple years ago, actually, when we had some business for PeakBot going on down in Florida.
Yeah.
And both of us went with our wives. We went
to Animal Kingdom, right?
Yeah. I love Animal Kingdom.
Animal Kingdom was sweet. I mean, to be honest with you. Yeah. Look, there's things that these parks, the technology alone, right, is crazy. I think their logistics and their operations, when you see, I've fallen into these traps before on socials where you talk about the Disney and all the tunnels underneath the thing and they use these specific colors here to make you look away from this wall and all the factories going on and everything. It is nuts. I don't know how they do it, right? Like just the total infrastructure of everything. It's incredibly impressive. It is to many the 8th, 9th, 10th, and 11th wonder of the world, however many parks there are. But anyway, yeah, I love Disney. Last I went was with my wife. We went to Epcot, and she was actually pregnant, so she couldn't do the whole drinking part of eating and drinking around the world. So I did it. I did 2X for her on the eating side mostly. But I'll tell you the highlight, and then we'll get into the stock, was at Epcot. My espresso martini from the Italy section. It was very good. That was probably the highlight. But anyway, okay. Let's talk about the stuff.
1 second.
What?
I've gotta, because we talked about this, I've gotta ask you guys a question.
Please.
What do you think? And this is a Guinness World Record. What is the longest streak of an adult visiting Disney? How many consecutive days?
Days?
Yeah. How many days in a row is the record for visiting Disney?
Matt, do you have any idea? You got to guess.
These numbers are always far, far bigger than you think they could ever be. Let me tell you a quick aside. This would be something that would come up in a trading pit where we were all standing around very bored with nothing to do, and someone would ask the question, and then we would all not only make markets on it, but then we would bet on it. And so this is a great way to lose $2,500. But I'm gonna say my guess is somewhere between 2,500 and 3,000 days. I'm 2,500, 3,000. That's my market.
All right. Dillon, we'll give you a range of 500 as well.
Oh, that's fine. I honestly, I was going to go in that range. You know,
Okay.
I was going to say, I'm going to go with 2,000 to 2,500 because do they get sick? Do they stub a toe? Like, I don't know. Go ahead. What's up, Ben? What do you have a guess? Or you
Just
look it up?
between the two of us, there's already a trade here. I bought 2,500.
Yeah.
2,500.
I did.
Yep. There we go.
What's
There we
the
go.
answer, Ben?
Ben.
Oh, Matt.
Whoa.
Matt nailed it.
29.95.
I could have pegged this guy from a mile away. In fact, that might be. Is that my Uncle Ronald? What's going on?
He
What's this
started.
guy's name? That's
Here's
too
the best
funny.
part. The guy started in 2012, and the only reason he stopped was because of COVID. I just punched this dude up. That's amazing.
Incredible.
He'd still be
Incredible.
rocking it. He would still be going.
Damn
For sure.
COVID, man.
That is
Yeah.
awesome.
That's true. You know, he
That's-
didn't even have a choice.
That's some dedication, man. That's
Jeff,
some
right.
real dedication. Dylan, why
There
don't
you
you
go.
pull up the chart? We'll talk about some trade ideas for Disney.
Okay, and then we'll keep moving. All right. So this is not financial advice, not financial advisor. I'm just looking at the chart here. Here's what I'm seeing. So here's Disney over the last year. Now, I've traded Disney on our trend spread strategy, which no longer is active and in the market. Just wasn't keeping up with market conditions, and we've built better bots. But I've also traded it manually a few times. And when I'm looking at it here, again, in fact, let's just go year to date. All right. So Disney's opened the year right around this 110 price. All right. Traded in that range of, 106 to 115 for quite a while here. And then the whole fallout happened in March into April. Stocks seemed to recover, float back into that area for a little bit. It seemed to find a new channel with highs of around 125 back in June of this year. And now, since that high, we've kind of been we've been bearish for sure. Not dramatic decreases, but certainly steady price coming down here. So when we were looking at this backstage, if we zoom in here, We got the daily bars up. I think there's some type of sorry about that. I think there's something to be said. Ben, we were looking at pre-market. It's up, maybe around this 111 price, which you could say had a little bit of consolidation around, but you were saying 113, maybe even a call credit spread. I went and I built it.
Let's see it.
Just to see what it looks like. So if we were to put a call credit spread out for $1, all right, so $100 in risk minus the premium collected, the mid is a quarter right now. So $25, which, not terrible. This is not a terrible trade. If we were to widen it a little bit here, we're going to get 42 at the mid instead of 25. So that's, opening up your risk obviously a bit more. But Ben, I don't know what you think. If take another look at this, I was looking at the technicals, and I think they're a little bullish, but I do think it's probably going to hit that level and maybe come back down. Do you have any insight on it or anything else we want to share on this?
No, I mean, just based on the look of the trend and, we still have to look at economic events for this week for the market in general. Not that would particularly all of that affect Disney. I personally think I would remain bearish throughout the week. It did look like there was some further back support, maybe at it's a little too small for me to read.
Sorry.
Yeah, I can't see that price. 109 maybe.
All right. I'm not
sure. Around the 109-ish level. And that goes back to a couple months ago as well. There's a bounce off that level. Actually, right around there. So that would be my only hesitation. But hey, if somebody said you need to trade this week, this is probably the trade I would go with.
All right. Well, again, not financial advice. Something I might throw out there just to see if it fills around 25. Maybe I'll take another look at it. If I take the trade, I'll post it on our.
Hey, how'd your trade go on Friday that you took?
Oh man, it's so nice that you asked. Let's get this. Let's get this off. Let's come back to all three of us here. I don't know how we do this. All right, that works. We can make Ben. It went well.
Can I make one really quick aside about the Disney trade?
Please.
And this goes for any trade. I think people always need to make sure you can look at the chart, and I think the chart is a great way to design trades and think about things and look at levels and et cetera, et cetera. Never forget that if you're trading options, you're trading implied volatility. Even when you're trading spreads, right? Even when you're trading call credit spreads where you're short one leg and long another leg, you're going to be trading less of that implied volatility because you're short one and long one instead of just short everything or long everything, but you're still trading implied vol. The other thing is that the stock itself, the underlying or the index itself, also has what we call historical volatility, which is how much has that thing been moving for the last N number of days. Both of those pieces of data are at your fingertips now, just as I was talking about at the beginning of when we talked about, what's going on with education. Both of those things are at your fingertips now more than they ever have been before. So use them, right? Use them. The implied vol of the option you're trading and the historical vol of the thing that you are trading it on, right?
Yep.
And then look at them and then look at what they look like next to each other. The hard part about it is one of them is backward looking, the historical vol. That's why it's called historical vol. One of them is forward looking, the implied vol. And that's the art versus the science of the trading, right? Is the actual line between the historical vol and the implied vol. What's going to happen in the future? What has happened in the past? Sometimes they have a lot to do with each other. Sometimes they have nothing to do with each other. But make sure that those things are on your radar when you're talking about those and thinking about them. They don't have to be the be all end all of your trade decisions. Sometimes you can look at a trade just like you were talking about and say, it's worth 25 cents and I want to sell it. And okay, that's great too. Just make sure that that's a part of your kind of decision-making process as well.
Add it to the checklist. Have it in your checklist. Exactly. Look, that's the first level of things, right? When I'm looking at a chart, it's okay. Visually, I like what I see here. Let's dig deeper. You're absolutely right, Matt. Ben, did you have anything to share on that?
On volatility, not necessarily. However, it's worth noting that we are in a period of higher volatility over the last couple of weeks. I'd say starting with this wasn't the catalyst, but starting with the government shutdown, I think we saw some unusual price action start to happen. And then, of course, when Trump mentioned that he was going to slam China with tariffs, I think those might have been his exact words. We saw a huge spike up in VIX, and as we know, when volatility increases, our option prices will usually increase along with that volatility. So it makes trying to nail the top of that IV spike kind of fun, and then you profit on the IV crush when we're selling options. It's funny because if we look back in history, and Dillon, I know we did this on the show a couple weeks ago. If you look back in history, the spikes up in VIX are relatively short-lived, and it makes you think, like, I wonder how a bot would do if he said, hey, every time VIX is over 30, buy a 30 DTE put on it, right? Because it's coming back down. It historically have come back down pretty quick. You just have to figure out if the pricing makes sense on that put.
And duration of the option. Don't forget about that, right? Like how long does it take? How much are you willing to pay for it?
Yep.
And then that brings up another really interesting part about option pricing, which is skew, right? The skew in the VIX is, right? So we're talking about something that is a derivative of a derivative of a derivative now, right?
Wow.
The VIX, right, is a measure of the 30-day implied vol of the S&P 500. Then when you're starting to talk about options on the VIX, you're talking about a derivative on top of, right, something that measures variance essentially. And so it starts to get a little funky, particularly when you're dealing with like the skew of the options. One of the hardest things to think about when you think about the VIX options is the call skew. The call skew in the VIX is bananas, and many people have gone broke trading it, both sides, because it can get weird. And if you look at the price history of the VIX, you were just mentioning it, right? The spikes are crazy, but oftentimes they don't last for very long. And if you can stay liquid during the spikes, especially if you're like short calls in the VIX, then, a lot of times I have friends who make a very good living trading VIX options, and some of them trade them in very good size from the short side. But those people also have a lot of money, like a lot of money. So it matters, and duration matters. I'm just putting that out there. Like, make sure you understand what you're trading.
Matt, I love having you on the show, specifically in the role you're playing right now, where Dillon and I can talk about some pretty irresponsible trade ideas, and then you kind of step in, and then you're just like, whoa. Let's think about it.
I don't ever want to tell someone not to trade things. I think like trading generally is a good thing. I just want to make sure that people understand what they're trading, because a lot of times when people look at the VIX, they look at it and they think about it like it's just another stock. And it's not a stock, right? It's a measure of volatility on the S&P 500 options, and particularly the 30-day option. And so you need to know what you're trading, right? I talk about that all the time on my like LinkedIn posts, and I'm like, know what you're trading. That rule has never, ever gone away. As this market continues to get more and more complicated, and there's an ETF for everything, and oftentimes those ETFs involve optionality, you need to understand what that means. That's my whole point, right? Like, that's been the rule ever since I started trading, and it's ever more important now.
Yeah,
love
absolutely.
If any of your, sorry,
I was going to say, having rules in general when trading are very important. I mean, Dillon, you and I talk to traders all the time. The amount of people that don't have a set of rules that they're following, regardless if the rules are good or bad, who's to decide that? The market will decide that. But just having a set of rules is, in my opinion, one of the most critical parts of trading.
Got to have a set of rules. My set of rules is automating it. I got to know the rules behind the automation, but I let my emotions stay out of it as much as humanly possible. I'm a bad trader without automation. I'll say it. By the way, Matt, hey, any of your friends who got all this crazy cash trade and VIX, if any of them want to be copy traders, you send them over this way. We'll get them self-service up and running. Anyway, just kidding.
Okay. All right. I like that. I like that plug.
Hey, look, what do you got? Come on. All right. So
speaking of trades and bots, why don't we hop over into the bot shop? Let's switch up the music a little bit.
Let's do it.
Switch up the music. Let's get over to the bot shop. We're talking about BenBot. So the BenBot, for anybody new tuning in, this is a daily covered call strategy on IWM. You're buying the shares shortly after the open. You're going to sell a covered call on it. And then if price decreases on IWM, you're going to roll that call down. So that way your loss doesn't hurt as bad. And you could potentially even still turn that day into a win. If price just keeps going up, yes, our upside is capped, but we're going to make money on the shares and we're going to make money on, we're making money on that premium that we got at the beginning of the day. That's the ideal scenario. You get in, price goes up, you don't think about it for the rest of the day, you move on. If we are out of the money at the end of the day, the BenBot will close your position, so that way there is no overnight risk. And there are some instances where the bot will hold the IWM position overnight, there will always be a protective put. So that overnight exposure that everybody's so concerned about, not a problem with this bot. You're either not in a position or you've got a put hedge on overnight and your position will be protected. So last week we talked about entry time. This week, we're going to just briefly talk about the strike price and where the strike price lands for this particular bot. So if we wanted to just look at an options chain real quick, and I'll pull up my Tradier account here. I've got the IWM chain up for today, and it looks like our at the money's between 243 and 244 based on these color settings here. So what this bot would do is it would buy 100 shares per unit that you've got assigned. It would buy 100 shares at market price right around the open, a little after the open. And then it's going to sell the strike price rounded up, the at the money strike rounded up. So you're making some money on that premium. In this case, it looks to be about $1.26 in premium. I'll just send that to the ticket so we can view it a little bit easier. We've got $1.26 on the premium. And then we would, of course, sell, if price goes up, we would be forced to sell those shares at 244. So we would buy the stock for just below 244. And then if shares get called away, they got called away at a gain. So we're double dipping on the profits there. As we can see, IWM is up pre-market. So these won't be the actual strike prices at open. This is not our building a trade series here. We're just talking about the BenBot itself. So that's scenario one. Scenario two would be IWM decreases throughout the day and we roll that call strike down, because that 244 call, if price is dropping during the day, that 244 call is going to lose value. And as we're losing value, we might want to take profit on that call, sell another call a little bit lower. Still out of the money of the current position or of the current price, but we're going to keep rolling down. That could, if there's a big drop, put us in an instance where we will see a loss, even if price increased above where our short call is and we do get called away at a certain price. But the idea here is we're lessening the blow of any dips with more credit from selling these calls. So I don't know how good I just did at explaining that, but I'll say good enough.
I think you did well.
Yeah, good enough.
Let me ask you a question. Can I ask you a question about how is the strike chosen? Is it always the immediate at the money strike? Is it a delta kind of issue? How does it choose the strike?
It is at the money rounded up. Okay. So that's currently how we're choosing. I think, and don't quote me on this, but in the near future, we're going to leverage some of the AI models that we've been building at PeakBot to help us determine what strike price we want to trade.
Yeah, that's an interesting one too, right? Because then you can start to look at like back testing it for delta to say like what delta call is the perfect call, theoretically perfect call for a strategy like this to sell on an everyday basis, 10 days in a row or whatever it is, right? And that can be helpful as well.
Yep, exactly.
You could also, interestingly, I think there's an interesting thing here too. You said it rolls down, right?
Yep.
You can also, but if you guys are the ones doing the back testing, you can also think about like the initial call that you sell delta wise could be X. And then if it does roll down, you could do a separate back test that says, okay, in a case where the index has moved down enough that this would be true, that we would need to roll down, what then is the best delta of call to hold in the second iteration of it? So it might choose like the 26 delta or the 29 delta for the first one, but then it might actually go through and say, if the thing moves down far enough, you don't want to be short the 26 delta if it's down 2% because the rip roaring rally, right? Like could rip your face off. Maybe then you only want to be short the 23 delta or whatever down there. Who knows? But that's a perfect thing to back test, right? It's a beautiful thing.
I love that idea. And the rally that ripped your face off. We've seen, and we're speaking on just the daily context here, but we have seen where IWM will drop, a couple dollars at the beginning of the day and then recover that loss in the afternoon and then win some. So typically, and Matt, this is just your FYI for you, typically the bot's not going to roll until around 2 p.m.
Okay.
At around 2 p.m., that's when a roll decision will be made. It could happen earlier. Like if we do get a massive drop, like if we get like a $2 drop, we're rolling earlier. But the idea is, hey, let's hang in there. Let's see if price will recover. So thinking about where the strike is, at the money, round it up. Easier to sell shares for a higher price if called away because we're right there. We're right at the money. So if price bounces up a little bit and closes above our strike price, we're going to get our shares called away for more money for a higher price than we bought those shares for. So we're making money on the shares and we're making money on the premium that we collected when we sold the call. More assignment probability than the +2 strike, and we'll talk about the +2 strike in the part 2 slide here. And then, quote, smoother growth when markets are grinding higher. Not the case, of course, when markets are going sideways to down. But when markets are grinding higher at a nice rate, this is a fantastic strategy. I love trading this strategy in that type of market. The cons are lower premium collected on each trade when compared to the round down, less downside protection because of less premium, and then slower compounding of price chop sideways. That's kind of what we just said here. So why did we go with the at the money rounded up instead of the at the money rounded down? We did test both. And what we found was the opportunity, and we could glance over the pros and cons on the screen here, but the opportunity of selling your shares at a higher price because prices increased throughout the day, the gains that we saw from that outweighed the additional premium that we would collect on selling the at the money strike rounded down. So if IWM is at 243.50, we want to sell the 244 strike, not the 243 strike, for all the reasons that we just spoke about. Those are the two at the money strikes. Now, we just said there we found more opportunity rounding up. What if we rounded it up and then added $1 to it? And then conversely, what if we rounded down and added $1 to it? What did that look like? Now, I wish we had a bunch of charts to show, but too much data crunching and numbers to put it all together in time for this show. But if we went at the money +2, it's the maximum upside potential for selling our shares in these 4 different scenarios that we're talking about. Any assignment equals a big win on shares. So if we bought IWM at 243.50, and instead of selling the 244 strike, we would sell a 245 strike. And at the end of the day, IWM closed above 245. We would make $1.50 on those shares, plus the small premium that we would earn on selling that call. and it would be small because it is further out of the money, lower priced. We're selling that, less premium, less downside protection for us. And that was really the big downside of trading this way. Not much downside protection at all. Where the at the money strike -2, a lot of downside protection. You're earning a lot of premium. There's a lot of room for IWM to move down. So if we were trading at 243.50, we would sell the 242 strike. We've got $1.50 of room because we know at the end of the day, we want IWM to finish above 242, get those shares called away at 242. We're going to lose money on the assignment on the shares, right? Because we buy at 243.50 and we sell at 242, we're losing $1.50 there. But the idea is the premium that we get from selling the call is going to make up for that loss and then some. And that's giving us some further downside protection there. However, of course, as we mentioned, the best formula, if you will, at the moment, and we're always open to change. We're always looking at changes to make. The best formula is that at the money strike rounded up. So that's how we got to the strike prices on the BenBot. Next week, we will be talking about stops and take profit on the series. Fellas, any questions? Any questions about the BenBot? I know Matt.
I have something to add.
Yes, please.
Go.
In a situation where you're talking about strike +2 or strike -2,
yes,
which you just showed. I think it's really interesting to think about the fact that this position at its heart is, no matter what strike you choose, it sounds like the first thing this thing does is buy 100 shares of stock, right?
Yes.
And so the first thing you need to think about from a risk perspective is, I'm long 100 shares of stock, right? And then it's like, okay, the next layer of this trade is, which one of these options am I short against this 100 shares of stock? If you use that up to level, all of the things that you put up there are true. You start to sell options that have less premium in them. So the theoretical income that you make from that, right? I hate that word, but people use it all the time. The premium that you sell becomes smaller and smaller and smaller. And so when you think about it, I want you to think about it in terms of like, I'm selling a smaller option against the same 100 shares of stock, right? And so what you're getting is really just a position that's going to act more and more and more like you're long 100 shares of stock, right? The P&L of that trade is just going to look more and more similar to a P&L of 100 shares of stock. And then the opposite of that is true on the downside. If you choose the strike -2, right? It's going to have way more premium in it as a call, but you're still long 100 shares of stock. And so you're just selling more call premium against that. And the strike of it matters. The best way for you to look at how much extrinsic premium you're actually selling in that situation is to look at that put, the strike -2 on the put side, because the put is actually what you're kind of short. I know that's a little bit confusing for some people, but it's very easy for people. Yeah, it's very easy for people to look at the out of the money calls and say, well, the thing's trading like, 38 cents. I'm short 38 cents of premium. But if you, so for instance, where are we trading? Russell's 243-ish? Yeah.
Yeah, let's say this is at the money right here.
Okay.
So we were at the money. You said at the money -2, right?
Yeah.
So we would sell the 242.
Yes. For $2.50, call it, right?
And then say, look at the put side to help us figure out what that extrinsic value is.
That's the real extrinsic value of this trade, because how much of that call price is actually intrinsic, or what we call parity value, right? There's a portion of that 242 call with the stock trading 243.5, namely 1.5, that is actually just pure intrinsic value. And that value doesn't decay, right? Don't forget about that. Intrinsic value doesn't decay. Extrinsic value decays. So when you look at that call that you're selling for $2.50, I want you to look at it and say, okay, this is a call worth $2.50. I'm not going to lie to you. If the stock goes all the way down to that strike, that call is going to go out worthless and it's going to be worth zero. However, if nothing happens during the day, don't expect that call to go to zero. That call is going to go to its intrinsic value, which is $1.50 or somewhere around there. And how much are you actually going to get as theoretical income, as decay out of that trade? It's going to be represented at first by how much extrinsic value is on that strike, which is in the put, which he's highlighting right now, which is 80 cents basically. Okay, so that's a good, it can get a little complicated, but the reason why that works is put call parity, and we can talk about that some other time, but that's really what you're short. You're short 80 cents of extrinsic value, and you're short, whatever, $1.70 of intrinsic value in that situation. And the intrinsic value does not decay.
You got Ben. I know Ben. I've been working with Ben long enough. I've known Ben long enough. You got his brain spinning right now, man.
In a good way. In a good way. You got me thinking about how we present this to people, because there's a good amount of people trading the Ben bot, and a lot of people like the Ben bot because the drawdowns are low, right? Because we're basically long IWM, and IWM historically follows the market, and the market historically is up and to the right. Exactly.
You got it.
People do like trading, and I love explaining it this way, although that's not how we're trading it right now. It could be potential to trade this way in the future in a certain market. Well, what I'm thinking for V2 is, again, have AI help us determine what strike price to play on a certain day, and what we just talked about now would come into effect on those particular days. So we've got 15 minutes until the bell here, so I know we want to start getting wrapped up.
We need to have Matt back on.
We do. We didn't get to talk about King AI yet. King AI, our new AI bot coming out, 1DT Iron Condors. Just briefly what it is. And then Matt, you tell us if you want to come on for a part 2 soon about it.
Okay. All right.
So briefly, the King AI is a 1DTE Iron Condor. We're selling that Condor. However, unlike our King Condor strategy, which sells at the 20 delta all the time, AI is now using over 300 different market variables to help the bot determine what strike price is optimal for that particular day to sell our spreads at for that Iron Condor. So it could be, and we go in increments of 5 deltas. So it could be the 10 delta, the 15 delta, the 20 delta, or the 25 delta. And hey, if the confidence level comes back too low on our AI model, no trade. We've been testing this live for the last month. The strategy has lost once in that last month. We are starting beta on this strategy today. So we will be talking about the results of beta this week on our Friday show. But really, really excited about this launch. I'm really excited to have AI worked into our bots. I mean, I feel like we're late to that game, but
no,
we wanted to do
let me
it
step
right.
in. I don't think we're late at all. I think those responsible with the cash, the resources, and the time get to it whenever they need to get to it. The retail trader still doesn't know what to do with AI. The retail trader doesn't know what to do with most things. and that's not an insult. That's just generally speaking, right? The problem that we're all trying to solve here. I think we're right on time with AI. And as we're saying it, I hate to say this, but sometimes it does feel dirty just because there's so much good AI and bad AI out there already for retail traders. But, I think we're being responsible with it. We could have rolled this out as soon as we saw a 97% win rate in our back test. And, we can't believe things. But we need to take the time here. We need to get the data set. We need to collect everything. I don't think we're late, Ben. I think we're right on time.
Can I ask a question?
Yeah.
Yes.
Ben, when you're talking about 15 or 20 delta, which delta are you talking about? Is that the inside strike?
Inside.
We're selling on each side those strikes.
Okay, so it's the 15 delta call and put, and then it's got the wingers long on the outside of it? Or is that the combined?
Each side can be different. No, each side can be a different delta. So we could sell the 15 on the call side, and we could sell the 20 on the put side.
Okay. Yeah. It's interesting. It's a really interesting. I mean, I know there's a ton of people doing these trades. It's amazing.
Yeah.
We'll have to show you some data and let you nerd out on it, maybe off screen, and then we can have you back for a part 2 for sure.
Yeah, I would love to talk about it. I'm certainly willing to, especially look at the data and then be able to weigh in on like, okay, well, these are the risks that I would look at as far as just from an option perspective broadly, and then, help to build a clearer picture of the risks and benefits of that trade as well.
I love that. A live workshop. That's what I'm hearing right now. I love that.
I love it. I'm on board.
Okay.
I'm on board.
All right, cool. All right. So let's quickly go through economic events for this week, because I feel like that's something that we always need to end with. And then Dillon, why don't you go ahead and get us wrapped up? So looking into today, not much, again, to be concerned about. We're looking for when the 3 bars here are highlighted in blue, high impact events. Tomorrow, again, nothing major going on. On Wednesday, we've got a lot. We've got the 20-year bond auction, which will turn some bots off. Some of our bots do not trade during 20-year bond auctions. That's 10, 20, and 30-year bond auctions. Those bots could be off for. And we've got jobs reports coming in on Thursday. We've got mortgage rates. Again, nothing really shutting our bots off. And then on Friday, we've got CPI data. We've got that Michigan Consumer Sentiment Report. Matt, did you ever think that the Michigan Consumer Sentiment Report would be talked about?
Yes, I did.
5 years ago. 5 years ago.
No, not in the way that it is. Not in the way that it is now. But when I will say this, I was joking about this when I was just in Italy. When we used to at DRW, our automated market making strategies it was right at the beginning of like rolling out co-located servers and the whole 9 yards, and we were making markets on the screen in very big size in Boone, Bobble, Shots, Euribor, all these things. And so we had a list exactly like this where we set Bloomberg alerts that we would turn our bots off, right? Yep. During those situations. And this was a long time ago. But the number one that we thought was absolutely hilarious was the Italian goods and services number. Because it was so minimal, but the risk metrics said that we should turn the bot off every time that the Italian goods and services came out. And it was absolutely hilarious. But so anyway, the Michigan number is very important, just as all of the other economic indicator numbers are.
This one's right. We haven't had fun with the Michigan Consumer Sentiment Report on our side. It's really, before we were aware of how much that can ruin a 0DTE SPX position. I should say before we were aware, but the impact kind of showed up out of nowhere. But anyway.
All right. So Matt, you did mention you went to Italy. I need you to tell us your favorite thing that you did and your favorite thing that you ate, and then we're gonna wrap.
Oh boy, holy cow! The favorite thing that I did, we splurged and got a private tour of the Uffizi in Florence.
In Florence,
and it was a 4-hour tour. Not only of the Uffizi, but also of the Academy, which is where the David is. And, just the amount of history and backstory for all of that was something that set us up to really understand all of the art and all of the things that we saw for the next 10 days. So that was amazing. Favorite thing I ate was a pasta dish that was like beyond measure and amazing at the hotel that we were staying at. We spent half of our time in Florence and half of our time in Lake Como. So the Lake Como leg was completely bananas. So
love it.
That was it.
Absolutely love it.
Excellent, man. Well, we love, Ben and I visited Italy together with our wives a couple years ago and are both itching to get back. So look, Matt, thank you so much for joining. We definitely need you back for a part 2. And if anybody has any questions for Matt, we'll make sure you can find out where he is and how you can contact him, what their great things they're doing over at the OIC and the OCC. But Ben and I will be live again Friday at noon Eastern for the Automation Station. Thank you so much for tuning in. And as always, we'll see you at the peak. Take care, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.